This is a video on, again, capital leases, but from the lessor standpoint, not the lessee, but the lessor standpoint. We're going to talk about, for most of this video, about a category called direct financing leases. But before we talk about direct financing leases, let's go back through the process a lessor would go through to determine whether or not a lease is a capital lease or an operating lease. So we go back to the attributes of a capital lease, and just as for the lessee, the attributes are same for the lessor. It says the presence of any of the following attributes in the lease agreement or any side agreement to the lease, and the four attributes providing for a transfer of ownership, contains a bargain purchase option, a BPO. Lease term is 75% or more than the asset's useful life, or the present value of the minimum lease payments, or at least 90% of the fair value of the leased property. If any one of these four components are present, this will initially be considered a capital lease. However, the lessor has two additional hurdles to jump through to determine whether the item is a capital lease or not. In addition to one of the four attributes that have to be fulfilled, the lessor also must understand that the additional following conditions must exist. Number one, the collectibility of payments and reasonably predictable. Number one. And number two, there are no material uncertainties regarding reimbursable costs to be incurred by the lessor. So in addition to at least one out of those four criteria being met, these additional two criteria must be met in order to be considered as a capital lease for the lessor. Anything else, and it would not be a capital lease. Now, when we take a look, there are differences in accounting for capital lease versus operating lease. Capital lease, when the lessor does decide that the lease is a capital lease, it must decide whether or not it is one of two categories. The first one being a direct financing lease, and the second category being a sales type lease. Now, a direct financing lease occurs when the lessor's its primary economic interest is in financing the asset. In other words, it's basically lending the money for that asset. It could be a bank, leasing company, things like that. The other type of lease would be called a sales type of lease, where the lessor's economic interest is actually twofold. It's interested in making a profit off of selling the product itself and financing the sale of that asset. Now, in the case of operating leases, it's a little bit simpler, where the leased asset sits on the lessor's balance sheet and it's subject to depreciation like any asset the lessor would own. And also, lease payments are considered rental income over the term of the lease. So now we're going to go a little bit deeper into the area of capital leases. And again, the differentiate between a direct finance lease and a sales type lease. And we can see again, in terms of capital leases for the lessor, there is a split between direct financing lease and sales type leases. Okay, again, for a direct financing lease, the lessor has no economic interest in the transaction other than financing the purchase. In other words, making money off of the interest. So what happens in this case is the leasing company buys the asset from the vendor and then leases it to the buyer, in effect the lessee. So again, revenues derived from the interest income on the lease. And what we'll see, the fair value of the property that it purchases and its cost are the same at the inception of the lease. Now, the other type of lease, as far as capital lease goes, is a sales type lease. And in this case, the lessor sells and finances a property to the lessee. Now, in this case, again, the company sells the asset to the buyer and provides financing through a lease to the buyer, in effect the lessee. Again, revenues derived from the gross profit associated with the sale and the interest income on the lease. And again, the seller, in effect, / lessor makes a profit on the sale / lease of the property. And the fair value is normally higher than the cost of the leased property. Now we're going to go on and see how we perform an initial measurement and then subsequent recording of lease payments for a direct financing lease. Now, what we can see is under a direct financing lease, there's three major components for which we need to be concerned. The first one is what we call the gross investment, and that equals our total minimum lease payments over the term of the lease, which includes the total cash and any other assets the lessor expects to receive over the lease term. Also, if there are any unguaranteed residual values of the property, that also needs to be included in the gross investment. The second component we need to be concerned about is called the net investment. And the net investment equals the present value, and the present value, when we discount it back, it's going to be the implicit interest rate of the lease agreement itself. So it would be the present value of the implicit interest rate of our gross investment in the lease. Then the last component is what we consider to be unearned interest income. That equals our gross investment minus our net investment, our previous two calculations. So the difference between the two is the unearned interest amount. Now, when we create the initial measurement in terms of a direct financing type of lease, the first thing the company is going to do, the leasing company is going to do, is actually purchase the asset. So in this case, we're going to debit the asset and then we're going to credit cash, and that will represent the asset that's been purchased to be financed to this third party. Okay, at the same time, or when the lease agreement is signed, then we're going to perform the initial lease measurement, and this is where the lease is, where the asset is leased to the lessor. And in this case, we're going to debit lease payments receivable for the gross investment of the lease. We're going to credit our asset, the asset from our asset purchase, and we're going to credit unrealized interest income. So let's go ahead and look at the our example of this initial measurement. Zenez Finance Corporation agreed to acquire and lease a machine to a customer. The customer, which is the lessee, entered into a 3-year lease agreement to pay Zenez $100,000 per year for 3 years for the use of the machine. The machine cost Zenez Finance Corporation $248,690 to acquire the lease. The implicit rate of the interest on this lease is 10%. The lease was a direct financing lease, so that's how we're going to account for it. Now, the present value of an ordinary annuity for 3 years at the implicit interest rate of 10% is 2.4869, so we know the present value factor to work with. So the first thing Zenez has to do is purchase that leased asset from the original vendor. So we would be debiting leased asset for $248,690, and we'd credit cash for $248,690. Now, at the point where the lease is signed by Zenez Corporation's customer, we're going to now initially measure the lease. And in this case, we're going to debit our lease payments receivable for a total of $300,000, which is $100,000 per year over 3 years. Now, also, the value of our leased asset is going to be reduced. In other words, it's going to be removed from our balance sheet because we're not going to own it, $248,690. And basically, that's going to be also, that'll basically be the $100,000 minimum rental payment times 2.4869. So the leased asset and the present value at this point in time equal each other, so everything works out theoretically, and this is how it would work for all practical purposes in an actual transaction. So the difference between the two then is our unearned interest income. Now that we have established the initial measurement, let's go on and take a look at the subsequent amortization of the lease over the 3 years. Okay, now in this particular case, we take a look at year number one. And again, this type of table should be familiar with you, and you should memorize this table because it's really important, at least the calculations in the table. We have an end of the year period, we have our beginning net investment, we have our effective interest rate, we have our interest income, so our beginning investment times our effective interest rate equals our interest income in this case, minus any cash receipts we receive on the lease. So what happens is that we take the interest income subtracted from the cash receipts on the lease, and that's going to equal our reduction of our net investment. And we take our reduction of net investment from our beginning investment, and we end up with an ending net investment. So let's take a look at what happens with year number one. At the end of year one, when the lease payment is made, $100,000, we start out with our beginning net investment of $248,690. To calculate the interest income, we take the $248,690, we multiply it times the implicit interest rate, which is 10% in this particular case. And then it's going to come out to $248,690 times 10% equals $24,869. From that, then, we're going to apply our $100,000 payment. So therefore, the net between our cash receipt on the lease and our interest income, the net will be a reduction of our net investment of $75,131. So we subtract that reduction of our net investment from our beginning net investment, and we end up with our ending net investment of $173,559. Now, if we take a look at the journal entries that would have been generated in year one based upon this calculation, what we're going to see here is again, also notice that entries A and B from the previous slides have already been entered. So now we have to be concerned with entries C and D. So in this case, we would receive cash of $100,000. So we would debit cash $100,000, and we would credit our lease payments receivable for $100,000. And you can see the debit to cash for $100,000 and a credit to our lease payments receivable for $100,000. And you'll notice now there's a net balance of $200,000. Okay, now we would also debit our earned income for the amortization of the receivable, and that would be $24,869. Sorry, the amortization of the investment. That'd be unearned income. We would debit for $24,869 and credit interest income for $24,869. So we take a look at entry D, and we can see that our interest unearned income goes down, debit, by $24,869. So now it has a balance left of $26,441, and we would credit interest revenue $24,869. Okay, let's go on to year number two. And in year number two, we start out with the beginning investment of $173,559 because that's the ending investment from the previous year. The implicit interest rate is 10%, so 10% applied to the $173,559 equals $17,350. That should actually be $359, but we'll just leave it like that. Okay, we apply our $100,000 cash receipt. And again, the reduction of our net investment is going to be $82,644, which is the net of the cash receipt minus our interest income. We then subtract our reduction of our net investment from the beginning net investment, and we end up now with $90,915. Now again, the journal entries from that transaction. Notice here that entries A through D are for previous slides, and I've grade them out to make sure that you'd be able to see only the pertinent, highlight the pertinent calculations. So we look at entry E, and it says debit cash $100,000, credit lease payments receivable $100,000. So we have our debit cash and we have our lease payment receivable of $100,000. So in the end, our lease receivable now has a balance of $100,000. in our second entry, F, we debit our unearned interest income, which is for the effective, the implicit interest rate, times our beginning net investment, $17,356, and we credit interest income, $17,356. So again, unearned interest income is debited for $17,356, giving us an ending balance of $9,085, and our interest income then is $17,356. Okay, let's take a look at year 3. Again, we start off with our beginning net investment of $90,915, which is from our ending investment in year number 2. And we multiply that times our implicit interest rate of 10%. And the interest income in this case, I've rounded it because of some rounding issues in our calculations to $9,085. And we then apply the $100,000 receipt in our lease, and we apply the interest to it first, and then after that we apply the remainder of that amount to the reduction of our net investment, and the reduction of our net investment would be $90,915. If we take that and we subtract that from our beginning investment, that's going to equal 0 as our ending net investment on our amortization schedule. So again, we're going to look at the entries for year number 3, and again, entries A through F are from previous slides, and they are grayed out. So the only thing you're going to see now are you're going to see the highlighted slides and the effect of those highlighted entries, and you're going to see the effect of those highlighted entries. So we have entry G. We debit cash for $100,000 and credit lease payments receivable. So here we're debiting cash for $100,000 and our lease receivable is $100,000. And again, at the end of year 3, when our lease is up, balance of our lease receivable is now equal to $0. We're also going to debit unearned interest income for $9,085, which is the amount that we calculated off of our amortization schedule, and we're going to credit interest income for $9,085. So in this case, we would debit unearned interest income for the $9,085, and when we add up the debits and credits, that's now going to have a 0 balance, and our interest income will be credit for $9,085. So that's an example of the amortization of the lease on the lessors from the lessor's point of view on a direct financing lease. Now let's take a look at one multiple choice question associated with the direct financing lease. Finance Co. leases computer equipment to customers under direct financing leases. So that means it buys the computer equipment from other companies and then uses that equipment. It buys them on behalf of a customer, and then that equipment is financed by Finance Co. The equipment has no residual value at the end of the lease, and the leases do not contain any BPOs. Finance Co. wishes to earn 8% interest on a 5-year lease of equipment with the fair value of $323,400. So the implicit interest rate is 8%. The present value of an annuity due of $1 at 8% for 5 years is 4.312. What is the total amount of interest that finance company will earn over the life of the lease? So again, you have your choices. Go ahead, stop your video. When you're ready to review the answers, restart your video. Okay, let's take a look at the answer to number 1. And the question again is, what is the total amount of interest revenue that finance company will earn over the life of the lease? In this case, the correct answer is A, $51,600. Now, it's actually a fairly simple calculation. If our equipment investment is $323,400, in order to earn 8%, you need to have payments of $75,000 per year for 5 years, which is $323,400 divided by the present value factor at 8% over the 5 years, 4.312. That means that we're going to have total lease payments, minimum rental payments of $375,000. In other words, as I mentioned, the annual payment of $75,000 for 5 years. So it's actually after that a simple matter of doing the calculation. It's $375,000 in lease payments, our minimum rental payments, minus the present or the value of our investment of $323,400. That means we're going to earn interest over the life of that lease of $51,600. So that's how we calculate the answer for question number 1. And that will be the end of the direct financing leases from a lessor standpoint. And the suggested next video is our leases, again from the lessor standpoint, capital leases, which now we are going to look at sales and financing leases. Thank you for your time.